In this episode, we talk about how to set a budget for charitable giving, and we let you know updates for 2026 that will make doing so more beneficial to your tax return. Let's get started.
Let's get some money.
From New Money, New Problems, it's the New Money, New Problems podcast, a show for successful professionals searching for the tools they need to navigate financial opportunities and obstacles they've never seen. Negotiating compensation, purchasing your first investment property, helping your family with money, the highs and lows of entrepreneurship. New Money brings new problems that require new solutions. Join us as we work through them together. I'm Brenton Harrison, and this is the New Money, New Problems podcast.
Hello and welcome to this week's podcast. I am on the road yet again for hopefully what will be the last time for a good stretch of time. I'm a little bit tired of getting on flights, but I wanted to do an episode this week that kind of piggybacks on some things that have been going on when it comes to where we have been attending financial literacy events. We talked recently about the fact that my church had their 2025 financial literacy symposium, and around that same time, I sat down for an interview with NerdWallet, and we're going to put a link to that article in the show notes. And the title of that article was essentially, how do you determine how much to give for charitable endeavors, for a nonprofit, for a religious entity? Because it's one of those areas of finances where there's not like a hard and fast rule of thumb that you can point to tell you how much is enough or too little when it comes to charitable giving. When it comes to budgeting, you have these rules about exactly how much you should spend on housing and food and entertainment versus how much you should save. When it comes to how much you should withdraw from a retirement account, you have the 4% rule. But there's not much out there when it comes to how much should I decide to give to a charity in a given year. So in the first half of the episode, I'm going to share some tips that I think could help guide you along the way to determining the right answer for you or your household. And in the second half of the episode, I'm going to tell you about some updates from the quote unquote One Big Beautiful Bill Act that will make giving charitable contributions more beneficial, specifically for people who do not itemize their taxes in 2026 and beyond. And I want to start with talking about people who give based on religious observances. I try to stay away from politics and religion on this podcast, but I have shared that I'm a Seventh-day Adventist Christian, and our faith is very common for people to give 10% in tithe plus a liberal offering when you look at their religious contributions to their church. But that's not the only religion that we serve. And I will tell you that when people come to me and they're giving a set percentage because they feel led to by their religion, or it's strongly encouraged, or it's required, that's never something where we tell them, oh, you're giving too much. If you said you're giving 50% to your religious organization because that's what you've chosen to do, you're not going to hear me say, oh, you need to dial that back. Where I will give input, however, is telling you how that impacts the rest of your finances and let you understand the consequence of giving that much. Not a consequence in a negative way, but a consequence of just understanding the path that you've chosen to follow based on how much you're contributing. As an example, let's say that you have someone who starts with 100% of their paycheck, and on average, they pay 20 cents per every dollar in taxes. Well, now they're at 80% of their check right off the bat. Maybe they decide that they wanted to save 15% of their income because they saw online that that's how much you're supposed to save. Well, now they've gone from 80% down to 65%. If they've decided that they're going to give another 10 to 15% of their check towards religious observances, we're talking about actually spending 50 to 55% of what you make. But in most cases, people can't live off of 50 to 55% of their check. And it's not always due to lack of discipline. It could just be they live in a very expensive area. So when it comes to the thing that gets cut, it's often not the religious observances, it's how much you're able to save. So you look at someone who decides, hey, I'm committed to giving that 10 or 15%, but now it means that my savings rate is 2% or 5%, and that's not enough to do what I need to do financially. And I've had this conversation with friends where I say, hey, part of the faith walk, if that's the walk that you're walking, is saying, hey, I understand that if I'm going to make this level of contribution, it means that I'm going to have to lean on that higher power in which I believe so strongly to make up the gaps. But it also means that there are other areas of my finances that are going to look different than most. It's highly unlikely, if that's your path, that you're going to save your way to wealth. It's more likely that you're going to build up income sources or have to build up a business, in my instance, where you're hoping that there's some valuation from that business that you could sell for a profit. Or you may have to work longer, where you look at people who are in certain religions and it's like, hey, if I were able to not give that 10, 15% of my pay towards my religious institution, there's the potential that I could be further ahead financially. But because of that commitment, I'm working a little longer. And to me, as long as you're okay with that being your circumstance, that's fine with me. But having that understanding is crucial when you're talking about how much to give for religious observances. If it's not a religious observance, I want there to be an internal conversation or a conversation with your spouse about what your giving plan looks like. And giving plan doesn't just have to be the exact dollar amount that you give, although that can be helpful. I'll give you some examples. A giving plan could be sitting down and figuring out what types of organizations are we going to contribute to in the coming year. It could be, are we going to contribute to multiple organizations, or are we going to concentrate our efforts with a certain nonprofit? It could be, hey, we have reached some status in our career, and as a result, we're asked to be on a host committee for certain nonprofits or be part of a sponsorship for a charitable breakfast or dinner. Are we going to participate in these events? Are we going to be a certain level of sponsor? If we're going to a dinner on behalf of someone else and they start passing around the envelope asking us how much to give, what is a reasonable contribution that we think is appropriate for what we're going to do in that instance? And it's helpful in my experience because when you have that conversation either internally or with a spouse ahead of time, it can prevent you from some awkward situations where you haven't practiced how you're going to get out of it. If somebody asks you to give $1,000 and you either don't have it to give or it doesn't fit in with your spending plan, there's some value in having some scripts that you can say, hey, I appreciate you thinking of me. There's other organizations to which we're planning to contribute for this year. As a result of that plan, we've decided that for each organization, we're going to try to stay within this amount. So that's what I'm able to give. Having that type of conversation can save you from some instances where somebody might ask you to join a board that has a minimum contribution that you can't match, or they do ask you to participate in like hosting an event. And a condition of hosting requires you to give more than you are able to give. So have a conversation internally or with your spouse about the structure of your spending plan for the year. The next part is to determine whether there is a tax component to how you're giving. We're going to have some future episodes where we talk about ways that you can give like donor advised funds and donating appreciated stock. But you first want to have an understanding of why are we doing this? Yes, we want to contribute to these organizations, but is there a tax component to it? And if there's a tax component to it, it needs to be part of a comprehensive strategy. And that strategy might dictate how much you give. In fact, it might dictate how much you have to give to even be able to benefit from a tax perspective, which is what we'll talk about after the break. And lastly, once you've gone through those components and you've settled on what you think is an appropriate amount, compare that amount to what you're saving in other areas of your finances. If you do give for religious reasons and you can't match your individual savings rate with your giving rate, if that's what you've decided on, that's okay. But going back to taxes, if part of your tax plan dictates you giving 5% of your pay in charitable giving, but you find out that you're only giving 3% of your pay towards savings and investments, that's an example of a plan that's out of whack because you don't want the tax tail to wag the dog where you're doing so much to avoid taxes that you're actually not focusing on the things that do benefit you in growing your wealth when it comes to how you give and how you invest. So those are some of the things that we shared in the NerdWallet article that we'll put in the show notes. And after the break, we'll give you details about the changes that are coming to charitable giving in 2026 and beyond for your tax return.
This is the New Money, New Problems podcast, a show for successful professionals searching for the tools they need to navigate financial opportunities and obstacles they've never seen. We'll be right back.
Are you wondering what new money problems you might be overlooking in your financial life? If so, we've got great news. We've crafted the New Money, New Problems Gap Finder to identify potential weaknesses in your finances in areas ranging from budgeting, investments, insurance, and even the threat your extended family's finances could pose to your household. Please head to newmoneynewproblems.com/gapfinder to complete it today. Again, that's newmoneynewproblems.com/gapfinder to take the assessment.
You're You're listening to the New Money, New Problems podcast. Subscribe now at newmoneynewproblems.com. Welcome back.
Welcome back, and let's dig into pre-One Big Beautiful Bill Act and how it was impacted by charitable giving and post-2026 and beyond. Right now, 2025 and in years earlier, if you wanted to have charitable giving be a part of your tax plan, you had to be someone that itemized your taxes. Going back to the formula, you take your total income, you have certain above-the-line tax deductions that anyone can benefit from, such as pre-tax retirement contributions or health savings account contributions. After you've taken advantage of those above-the-line tax deductions, you have your adjusted gross income. And at that point, you have to make a decision of whether you're going to take the standard deduction available to all taxpayers, or whether you're actually going to tally up your own itemized tax deductions because they exceed what's available in the standard deduction. Well, prior to 2026, the only way that charitable giving would help you from your tax return is if you chose to itemize. As a matter of fact, it's very similar to what we've talked about with owning a home, where someone will tell you to buy a home because it helps you on your taxes. And in reality, buying a home only helps on your taxes if you itemize. And while people do give to charities for the right reasons, I cannot tell you how many people will total up, hey, I gave $50 at this breakfast, $100 at this breakfast at the end of the year, thinking they'll get some benefit from it, just to be told, hey, in your circumstance, it doesn't really matter because you've chosen to take the standard deduction. It's more than what you have available on the itemized side. So this isn't something from which you'll be able to benefit. Now that's changing radically as a result of the One Big Beautiful Bill. I just need to remind every time I say that, that's not my nickname for it. That's the actual name of the bill. But it did change charitable giving in some really unique ways. The first is, if you choose to take the standard deduction, it creates an above-the-line tax deduction for charitable giving. If you're a single taxpayer, it's up to $1,000 of charitable contributions. If you're a married filing jointly taxpayer, it's up to $2,000. So you, for example, might make $100,000 of total income. If you gave $5,000 in charitable contributions and chose to take the standard deduction, you'd be able to deduct $2,000 worth of that $5,000 of contributions as an above-the-line tax deduction before you reach your adjusted gross income. Now that's a big benefit to people who couldn't participate before, but unfortunately there's been a barrier introduced to people who itemize their taxes. And this makes sense because the Trump administration has been trying since their first go-around to make sure that the overwhelming majority of people are using the standard deduction. So they in some ways try to disincentivize you from itemizing, and this threshold is something that I think is an example of that. The threshold is 0.5% of your adjusted gross income, and it's similar in the way it works to how medical expenses work. So for medical expenses, if you itemize your tax return, you can only deduct the expenses that exceed 7.5% of your adjusted gross income. Let's say your adjusted gross income was $100,000. Well, you have to clear a $7,500 floor, 7.5% of that. So if you had $10,000 in medical expenses, you can really only deduct the $2,500 that's above that threshold. Well, with charitable giving, that 0.5% floor means that in the example of someone who has $100,000 adjusted gross income, they have to give at least $500 before anything above that amount can be deducted as an itemized deduction. So for our consistent $5,000 contribution example, in this instance, they will be able to deduct $4,500 because that's the amount that clears the 0.5% floor. Now, it's important that you understand that these have to be cash contributions. So as I said, we're going to do some future episodes where we talk about some of the things that you might have heard about unique ways to give that are beneficial. But the contributions that meet this threshold have to be ones that are given directly. It can't be through something like a donor advised fund. And this is why, if this is something that you're doing for tax purposes, it has to be integrated with an entire strategy, both so you understand just how much you have to give before it actually benefits you, and telling your tax preparer how much you plan to give so they can let you know in which strategy that might fit best. For example, let's say we had someone who wanted to give $1,000, but that's not that high above their 0.5% threshold. They may actually get more benefit from using the new above the line tax deduction that's available for people who file for the standard deduction. So having a plan in place and an understanding of how this fits into the other elements of your finances is crucial, because even something as seemingly small as giving $100 to an organization you're passionate about is something that has an impact on the rest of your finances. Nothing that you do when it comes to money happens in a vacuum. It all touches the other areas of your plan, and having the knowledge of how it touches those areas is crucial in making sure you use it to the benefit of your wealth. I'll see you next week.
From New Money, New Problems, this was the New Money, New Problems podcast, a show for successful professionals searching for the tools they need to navigate financial opportunities and obstacles they've never seen.